Copper just hit an all-time high above $14,000 per ton in late January. That is not some random headline number someone chose to make a thumbnail. That is the actual price the market demanded for one of the most important metals on the planet. Then copper corrected. It pulled back to around $5.80 per pound. And if you watched financial television for more than 5 minutes, you heard the same story on loop. Bubble. Speculation. Overreaction. End of the move. Nothing to see here. But at almost the exact same time, Bloomberg NEF warned that a structural deficit in the global copper market could begin as early as 2026, not 2030. Not some faraway problem for the next generation. This year. So which story should you believe? Is copper just a crazy trade that already happened? Or is this the market briefly glimpsing a much more expensive future and then looking away because that future feels uncomfortable? My name is Max, and on this channel, I try to make global money stories simple enough for normal people to actually use. If you want more calm, long-term Jiao Duke Tai Chin without the screaming and the hype, you can hit subscribe and like. It helps the channel more than you think. But whether you subscribe or not, by the end of this video, you will understand 3 things. First, why copper is not just another boring industrial metal, but the wiring inside almost every big trend we talk about. Second, why supply cannot react fast enough no matter how high the price goes in the short term. And third, how you as an everyday investor can think about this story without chasing headlines or doing anything reckless. Let us start with the part almost everybody gets wrong, the supply picture. Most commentary sounds like this. Yes, Max. Copper spiked because speculators went crazy. Tariffs scared people. Then it dropped so clearly that price was too high, and the market will sort itself out. Supply will adjust. Mines will produce more. Problem solved. That advice is comforting. It is also dangerously incomplete. To see why, I want you to imagine a giant mountain reservoir that feeds an entire country. You have pipes running down the mountain into every city. Factories, homes, data centers, farms, they all pull water from the same reservoir. For years, the water level has been slowly drifting lower. Not fast enough to panic anyone. Just a quiet, steady decline. Why? Because every year a little bit more water flows out than flows in. No crisis yet, but you are borrowing from the future. That is the copper market. For most of the last decade, we have been living off the old reservoir. Mines discovered and approved many years ago. According to the International Energy Agency, the world used roughly 25 million metric tons of copper in 2024. Production barely kept up, and that was before we really stepped on the accelerator for artificial intelligence, electric vehicles, and massive grid upgrades. Now here is the key point that a lot of talking heads skip. You cannot refill that reservoir on demand. You cannot click a button and have a new copper mine show up on the screen next quarter. From first discovery to actual production, a major copper mine usually takes 10 to 15 years. Sometimes longer. Think about everything packed inside that timeline. Geologists exploring a remote mountain range. Environmental studies, community negotiations, water rights, power lines, roads, ports, billions of dollars of financing, plus all the political risk that comes with digging a massive hole in someone else's backyard. If we announce a new mine today, most of the copper that mine will produce in its first 10 years is already spoken for. It will go to the cars, cables, batteries, and data centers we are planning right now. Not the demand that suddenly appeared because the price went up this quarter. So when you hear someone say, "Do not worry, supply will adjust," remember the reservoir. When the water level gets too low, price does not create water. Price just rations whatever is left to whoever is most desperate. And today, the list of desperate users of copper is getting longer every month. Let us talk about the 5 big forces that are all pulling on the same reservoir at once. Any one of these would be enough to push prices higher. Together, they create something we have not really seen in decades. Force number 1 is artificial intelligence and data centers. When most people hear about AI, they think about software, algorithms, maybe a few funny chatbot examples. They do not think about metal, but every new AI data center is basically a giant box of copper and steel that eats electricity. Inside, you have kilometers of heavy cables carrying enormous currents. You have transformers, switchgear, backup systems, cooling loops. Every one of those systems uses copper because you cannot cheat physics. If you look at estimates from industry analysts, a single large-scale AI data center can require 4,000 to 30,000 tons of copper, depending on design and how you count. Another way to picture it, think about a small city with all its wiring, transformers, and substations. Some of the newest data centers pull as much power as that city, and they need the copper to match. McKinsey and others expect global data center capacity to roughly triple by 2030. That is not a story for 2050. It is happening this decade. And because AI is now seen as a strategic priority, governments and mega caps are not going to say, oh, well, copper is expensive, let us slow down. They are going to pay the price. They would rather pay up than fall behind in the AI race. So, in the reservoir analogy, AI data centers are a new pipe drilled straight into the dam wall. And it is a big one. Force number 2 is the electric vehicle transition. This is one of those numbers that sounds small on paper but explodes when you scale it. A typical gasoline car uses around 20 to 25 kilograms of copper. Wiring, starter motor, some electronics, that is it. An electric vehicle uses roughly 60 to 80 kilograms. 2 to 4 times more. Why? Because the battery pack, the motors, the inverters, the onboard charger, the thicker cables, all need copper to move large amounts of current safely. Now take that per car difference and multiply it by millions of vehicles per year. Regulators in Europe, China, and more US states have already written rules that push automakers toward electric. Automakers have already committed hundreds of billions of dollars to new platforms and factories. That copper demand is locked in. Even if EV adoption is messy quarter to quarter, the long-term direction is baked into the policy and the capital spending. You cannot turn that ship around quickly without breaking entire business models. Force number 3 is green energy and the power grid. Solar panels, wind turbines, battery farms, and especially the transmission lines that connect everything to your home, all swallow copper. When you see a picture of a wind farm in the ocean, you mostly see the towers and blades. What you do not see under the water is long, heavy export cables running back to shore, made primarily of copper or sometimes aluminium, plus lots of copper at the endpoints. Imagine the wiring in a single house. Now imagine an entire country deciding to double the amount of electricity it pushes across its grid to handle electric cars, heat pumps, and data centers. Every transformer, every substation, every major line has to be upgraded. That is not just a one-time project. Most grids were built for an analog world. They were never designed for millions of electric cars charging at once, plus AI servers humming in the background. Energy agencies estimate that grid modernization alone could use more copper than all solar and wind hardware combined. Force number 4 is geopolitics. If you look at a map of where copper actually comes out of the ground, 2 countries matter a lot: Chile and Peru. Together, they produce close to 40% of mined copper. Both face political instability, community protests, water stress, and regulatory uncertainty. A labor strike at one giant mine or a change in tax rules might not sound like a big deal on television. But to the physical market, those events can remove hundreds of thousands of tons of expected supply or delay expansions for years. On top of that, the United States has flirted with using national security-style tariffs on copper. Section 2. 32-style measures, similar to what we saw with steel and aluminium. Traders have already responded by pulling metal off exchanges and into private storage, hedging against future policy risk. When you see a headline about a large trading house withdrawing a third of the available copper from a major exchange, that is not a sign of comfort. That is a sign that big players are nervous enough to stockpile. And then there is China. China dominates copper refining capacity, just like it dominated rare earths. If China ever decides it needs more refined copper for domestic EV and grid goals, and quietly restricts exports or prioritizes local users, The rest of the world would feel that shock almost immediately. Force number 5 is the pure math of structural deficit. Structural deficit sounds like jargon, so let us translate it into normal language. It simply means this. For several years in a row, the world consistently uses more copper than it produces, even after recycling. Not for a quarter or two, but as the default state of the market. In the early 2000s, we saw a version of this when China industrialized at high speed. Between 2001 and 2008, copper prices went from roughly $1,500 per ton to over 10,000. Roughly a 700% move. Back then, there was essentially one giant new demand story: China building cities and factories. Today, deficit forecasts look more serious because we have multiple large demand engines running at once. Electrification, AI, EVs, grid modernization, defense spending, all leaning on the same metal while big new mines are rare and slow. So when you put all 5 forces together, the $14,000 peak looks less like a crazy bubble and more like an early attempt by the market to price in a future where the reservoir is running low. If all of this is so obvious on paper, why do most investors still miss these kinds of moves? That brings us to psychology. Numbers are the easy part. The harder part is how our brains react to those numbers. There are 3 big traps here. The first is normality bias. Your mind assumes that because something has behaved a certain way for years, it will keep behaving like that. Copper has traded in a rough range for a long time. Your brain says, okay, this is a boring industrial metal that goes up and down a bit with the cycle. Nothing life-changing. So when price starts to break out, your instinct is to drag it back into the old mental box instead of updating the box. We do the same thing with our own finances. If we have always been in a certain salary band, we quietly assume that is our permanent level, even when new skills or opportunities could move us. The second trap is recency bias. After copper corrected from the peak, a lot of commentary sounded like this. See, the bubble popped, the move is over, back to normal. We anchor on the most recent price action and assume it will continue. But if you go back to the 2000s copper supercycle, you see multiple 20 to 30% corrections inside the larger move. Each one looked like the top at the time. Each one was actually a buying opportunity for people who understood the bigger picture. The third trap is what I like to call the glamour gap. Copper is not exciting. There are no viral TikTok clips about copper futures. Nobody brags at dinner about their favorite transmission line stock. So retail investors ignore it and chase whatever is currently trending instead. Meanwhile, long horizon capital, sovereign wealth funds, industrial giants, quietly build positions because the numbers make sense. In personal finance, we see the same pattern. People chase glamorous trades, hot tips, lottery ticket stories while ignoring simple, boring habits like consistently buying a diversified index fund every month. Over 10 or 20 years, the boring habit usually wins. Understanding these 3 biases matters because copper is not the last time you will see this movie. There will be other assets, other themes, where structural changes show up in slow, boring data long before they show up in exciting headlines. If you can train yourself to listen to the slow data and distrust your impulse to label everything a bubble just because it moved a lot, you give yourself a real edge as a long-term investor. So what do you do with all of this? Let us be very clear here. Nothing in this video is personal financial advice. I do not know your income, your debts, your goals, your risk tolerance, or your time horizon. This is education so you can ask better questions and make better decisions with a qualified professional when you need one. With that said, here's how I would think about copper from a max invest style, long-term Xiao perspective. First, zoom out. Copper is one building block inside the huge theme of electrification and AI infrastructure. If the thesis is roughly right, there will likely be many years, not weeks, where the world quietly realizes it did not plan enough supply. But that does not mean you slam your entire portfolio into one metal or one miner. Instead, think in layers. At the core, you want simple, diversified exposure to global businesses and broad markets. For many people, that might be low-cost index funds covering global equities, maybe some bonds depending on age and risk tolerance. On top of that core, you can add small, thoughtful thematic positions that express long-term views like electrification. That might include broad commodity funds or diversified mining funds, or even infrastructure funds that benefit from higher copper prices without being pure copper bets. The exact instrument is less important than the process. Ask yourself, if copper prices are extremely volatile for the next 5 years, can I emotionally handle watching this position swing without panicking? If the answer is no, keep your exposure tiny or stick to the broadest possible funds, or simply learn from the story without putting money into it at all. Another question, does this position fit inside my overall plan, or am I building my entire plan around this one idea? Copper should be a chapter in your investing book, not the whole book. You want your future self to look back and say, I understood the big forces early and I sized my bets like a professional, not like a gambler chasing the headline of the week. Finally, I want you to see copper as a case study in how slow, boring structural information eventually forces prices to move, even if the path is messy. You do not have to perfectly time any of this. You do not have to guess the exact top or bottom. You just have to build the habit of paying attention to reservoirs, not just waves. Is demand flowing faster than supply can realistically respond? Are inventories quietly shrinking while commentators are bored? Are big, patient players doing the opposite of short-term traders? Those questions work far beyond the copper market. They apply to how you think about your career, your skills, your savings rate, and your entire financial life. If you found this breakdown helpful, take a second and let me know in the comments which of the 5 forces you think is most powerful over the next decade. If you want more videos like this explaining big macro stories in simple, beginner-friendly language, make sure you are subscribed so you do not miss the next one. And if you want a great companion to this video, watch the episode where we break down how long-term investors can actually build a portfolio that survives inflation, recessions, and bubbles without trying to predict every headline. I will see you there.